The last few years have been dominated by investments. I think the next few years will be a little bit more mixed. We are a fairly insular or inward-looking economy. So to that extent, we are somewhat insulated from what happens outside of India. We can advocate to investors that this is a time to increase your allocation, because now on corrections, we are dipping into a zone which is fairly interesting. There are those FIIs who are here to stay. India is a central part of their investment thesis, their model. They have India dedicated funds and so on. India's inflation seems to have structurally come down, and the government view is changing a little bit from doing the capex to encouraging the capex.
Where do you see gold and silver in the next few months?
I would be very careful to get into commodities which have rallied by 150 and 70%.
Hello everyone, welcome to this session in conversation with Chirag Setalvad, our head Equities. So here we are here to discuss our overall macro view and our equity view as we decode our yearbook which we recently released. We will also discuss in detail as to what an investor should do when it comes to their overall equity allocations and whether to choose large, mid or small, or how to allocate between them. We will also discuss key sectors and themes, and as the session progresses, we will also have Chirag discussing in detail our portfolio positioning when it comes to the funds he manages. So hi Chirag, welcome to this show.
Thank you, Ram.
So in the yearbook, we detail in terms of how our economy has functioned in the last many decades, especially when it comes to the overall economic growth has been stellar in terms of its performance. This is despite in the recent past we have seen a lot of disruptions and uncertainties when it comes to the global events and the developments when it comes to the trade tariffs, etc. So my question to you is how resilient or to what extent are we de-risked from global events as we progress from here on?
So Ram, I think there are two parts to that. I think there is fundamental risk and then there is market risk. I think from a fundamental risk standpoint, we are fairly isolated or fairly insulated, I should say. And that's for two reasons. One, when you look at a broad macroeconomic level, our net exports at 15-17% of GDP means that we are a fairly insular or inward-looking economy. So to that extent, we are somewhat insulated from what happens outside of India. When you look at it from a earnings standpoint, about 25% of Nifty earnings is dependent on exports and performance of subsidiaries outside of India. So again, once again, to a large extent, what happens is dependent on what happens within the boundaries of our country. So from a fundamental standpoint, India is relatively insulated to what happens outside of it. But from a market standpoint, I don't think that is true, because liquidity, risk appetite, these are all global phenomenon and they certainly impact India as well. And if global markets are to come down, then India will certainly participate in that. And if global markets were to rally, then India would be part and parcel of that as well. So I think you have to look at fundamental risk differently from market risk. And the only nuance to that, I think, is even within fundamental risk, it depends, because there are some, we mentioned this 30% or 25% of Nifty earnings coming from exports. In some sectors, that is a far greater number, right? So obviously in IT and pharma and so on, those numbers are 70-80%. So those sectors are obviously incredibly impacted by what happens outside of India. And even from a macro standpoint, while exports as a percentage of GDP might be less, there are some sectors like textiles, etc., where the dependence on exports is a lot greater. So I think you have to detail that out a little bit, but from a fundamental standpoint, the risk is a little bit less, except for in specific areas. I think from a market standpoint, the risk is certainly there.
Thanks, Chirag. In the last year or so, we've seen some slowdown when it comes to the domestic consumption, and we've seen some shift from the government policy also towards addressing the domestic demand and consumption. So there is also a lot of investor interest we have seen when it comes to this theme and the funds surrounding this theme. So is it also your preferred theme when it comes to your portfolio positioning?
So I think a couple of things have changed. I think the last few years was dominated by government capex, specifically by central government capex, and that is certainly slowing down. So if you look at the next 2 years, that capex increase is about 10-12%, and if you look at the last 3-4 years, it's been closer to 15-20%. So we are seeing a slowdown which is happening from a government capex standpoint. And the government view is changing a little bit from doing the capex to encouraging the capex. So I think that's one thing to think about, that capex is certainly slowing down from a government standpoint. And on the other hand, there is a lot of encouragement which is being given to consumption, right? And we've seen in the last year that there has been a slew of measures, right? So it's not only, it's started off with tax cuts, we've had rate cuts, we've had GST rationalization, we will have ninth pay commission which comes in next year. So we've had a number of measures which are here to support the consumer. So I think the consumption piece is looking a little bit better. It's supported by the fact that we've had a better monsoon and so on. So government is pivoting a little bit to encouraging consumption a little bit more. Government spending itself is coming off. We're hoping that some of the slack in government capex will get picked up by the private sector side. Unfortunately, because of the tariff uncertainty, that's a little bit difficult at this juncture. But at some point, we're hopeful that private capex will pick up as well. But I think while the last few years have been dominated by investments, I think the next few years will be a little bit more mixed, and the skew will shift a little bit more towards consumption, but we'll have to see.
The biggest takeaway I would say from the yearbook is that we have turned constructive when it comes to valuations, especially as compared to last years. I remember the call in which you sounded a little bit caution when it comes to mid and small caps. So this year around, while there is no major price correction, there has been some sort of time correction that we have seen, barring the last few days. I mean, today also, I mean, the last few days we have seen some correction in the market. So does that excite you from a stock picking point of view? I think we have also mentioned that there are some stocks that have come down 20-30% in your, I'm sure many of them are part of your our investment universe as well. So does that give comfort when it comes to mid and small caps?
So let's dial back a little bit. I think we've had, the last year and a half has certainly seen a correction. But the prior 2 years before that, we saw a very, very sharp rally in mid cap, small cap. And retail sentiment had picked up, IPO market had picked up, there was a lot of liquidity, a lot of frenzy, a lot of excitement. So I would say almost 2 years ago is when we turned much more cautious on the mid cap and small cap segment, because valuations at one point in the mid cap segment had reached a premium of 50%. In small cap, it had at its peak gone as high as 60%. And even at a stock specific level, not at an aggregate level, we were not finding enough of opportunities. So for every 10 sell ideas, we only had 1, 2, 3, 4 buy ideas. So it was dominated by sell ideas. You couldn't find enough of opportunities, and hence we turned negative. I think a little bit, certainly earlier than the market as in aggregate, but we certainly turned negative. Now the story has changed, and before I get into whether we're constructive or not, we've seen a year and a half of time correction. Market has been flat for a year and a half. If you assume that earnings growth in that period is roughly 15% per annum, then a year and a half correction translates into a 20% correction in P multiples. Over and above that, we've seen mid caps have corrected from a price standpoint, so not the time correction, of about 5% from the top. Small caps have corrected by another 15% from the top. So effectively, the mid cap correction has been 20-25%, the small cap correction has been 30-35%, which means that this excess of 60% and 50% respectively in mid and small, those have come down substantially. So now mid cap trades at a 15-20% premium and small caps are at a 20-25% premium. So it is much better than where we are.
Sure.
So I would change that, are we constructive or not constructive today, to I would change the phrase a little bit. We were very negative some time back. That negativity has certainly come down significantly. And I think the interesting part is when you're at a 50-60% premium and the market corrects, it doesn't correct to a level which is interesting enough, because it's gone from very expensive to quite expensive or a little bit expensive. None of those are great opportunities. When you come to a level of 15-20% premiums, then all of a sudden from here, if the market were to correct, it would correct to either to fairness or to cheapness. And hence at every correction now, we can advocate to investors that this is a time to increase your allocation, because now on corrections, we are dipping into a zone which is fairly interesting. I think the additional point is, while indices may have corrected time and price as a combination by 20-25%, the individual corrections have been far greater. So let us look at the price correction part of it. The mid cap index is down by 5%, but almost a third of the index is down by 20%. The small cap index is down by about 15%, but almost a third of the index is down by 30-35%. So the individual corrections that we have seen at stock specific level have been even more. So as a result, while earlier we were faced with a scenario where we had many more sell opportunities and few buy opportunities, that skew is now improving. We've seen investor sentiment has moderated to a significant extent as well. And I think all of this plays into a better investment environment. So we are more constructive certainly on mid cap, small cap. Are we terribly excited? I don't think we are there yet. But from being very apprehensive, we are certainly less apprehensive, we are more constructive, and now we feel that on corrections, things will look a lot more interesting.
A lot has happened on the supply side as well. We have seen elevated level of activity in the primary market. I think about in the last 2 years, 65 to 70 billion worth of fundraising has happened, making India one of the largest markets when it comes to primary issuances. Now, while there has been talks that there has been promoters exiting and all that, but from an investment point of view, the investment universe from at least from a small cap, there is ever expanding universe. So from an alpha generation point of view or a stock selection point of view, does that excite you? There is so much to choose from. New sectors are coming into the picture from the listed universe. So would that excite you from a investment point of view?
I think it's yes and no, because the primary market, like you said, $60-70 billion, but it doesn't add up to that much from an incremental standpoint, right? So you have to be excited about the market in whole. It cannot just be the primary market which is exciting you, because that will only offer you that many new opportunities and that many new companies, right? In $1 trillion market cap, if you add $50-60 billion, it's not going to move the needle. It's not that there is enough of opportunities in the primary market that you can ignore the secondary market. It's also not that the primary market is always well priced, right? There's been a lot of excitement and euphoria in the last couple of years, and hence the $60-70 billion of IPOs have not come in at valuations which can create enough of excitement. Now, of course, we're seeing that a lot of these IPOs are underwater, and hence we are happy to look at them, post-listing. In some cases, it's 6 months later, some cases it's a year and a half later, where prices have now become a lot more favorable. So yes, the IPO market has provided a lot or sucked out a lot of liquidity. And I think that's a good thing, because had the liquidity not been sucked out, the $60-70 billion plus the promoter selling which would have taken place, which is over and above that, all that money would have stayed in the secondary market and it would have inflated things even more. And we needed the market to correct, and it's a genuinely a welcome correction that has taken place. But I don't think, of course, the primary market gives you individual opportunities which are interesting, but I don't think the primary market can any form or fashion substitute or make up for absences in the listed universe.
Sure, Chirag. The other point that I'm sure most of the viewers today are interested is the kind of absence of FIIs, or FIIs have been kind of withdrawing for the past few years. On the other side, the DIIs have come in a big way, backed by retail participation. I think for the first time ever, from a holding point of view, the DIIs hold more in Indian equities than FIIs. I think we have highlighted that in the yearbook as well. So, when do you see? So, do you see any change in that scenario? Do you see FIIs coming back, especially if there is some comfort on the valuation? Do you see a reversal in the near future or in the year 2026?
So I think there are a few parts to this. I think when you look at the FII segment, I think you can broadly break it up into two types. There are those FIIs who are here to stay. India is a central part of their investment thesis, their model. They have India dedicated funds and so on. This is a long-term commitment from their standpoint. So they don't come and go as much. Then there are those FIIs who invest in India through a Asia fund or a global fund or what have you. And for them, India is not necessarily a long-term commitment. They look at it more from a tactical standpoint. They will come and they will go depending on what the environment looks like. Obviously, the category we are talking and referring to is the category of FIIs which come and go. I think that segment has been partly driven out of India, or less interested, I should say, in India, partly because Indian valuations had become fairly elevated. And there was not much justification to look closely at India. At the same time, earnings growth had slowed down, which made it even less of an exciting story. At the same time, there was a lot of excitement outside of India. We had certain markets like Europe and China, which were very, very cheap from a valuation standpoint. You had other markets like Taiwan and Korea, etc., and US, which had a huge growth angle to it because of AI. And we had neither of those stories. We had neither a valuation story to talk about, neither did we have a massive growth story to talk about. So the India interest came off Now things are changing a little bit. I think one is the valuations themselves have become a lot more sensible. Second, I think there is a little bit of fatigue on the AI and super growth kind of narratives. And I think both of those will encourage FIIs to look at India to some extent. I think the only thing which will hold that back a little bit is last year was a fantastic year for equities. Developed markets did well, emerging markets did well. And if there is a correction in global markets, it will result in a risk off kind of approach, and in that environment people will not rush to markets like India, they may pause. But I think this is a cyclical phenomenon, that the interest in India for some foreign investors comes and goes, and I would suspect going forward more interest will come because we still remain a healthy growth economy. We still are now a market which is better priced, and I think all of that will encourage global flows to come back to India. I think the rupee depreciation has also been fairly sharp, and hopefully that's behind us. So I think that's one more reason that interest might come back. On the other hand, we've seen very, very strong domestic flows, and I think it is now easy to extrapolate that into the future and say it will continue to grow month on month and quarter on quarter. And I think we have to be careful about that. I don't think that should be taken as assumed or given. I'm not saying that will come off in a material fashion, but you could possibly see a greater interest coming from foreigners and a little bit lower interest coming from domestic investors, which is a reversal of what we've seen in the past. So I think this is the beauty of market. There is constant reversal which takes place. Sectors which do well and then others which take over, styles which do well and then another style takes over. So this rotation which happens also happens amongst investors and liquidity.
Interestingly, you mentioned about the rupee depreciation also. I mean, in the last 1 year, especially the USD has kind of come down against other currencies like Euro and the GBP or the Swiss currency, whereas Indian currency has seen some sort of depreciation. How do you view this? We've also had the BOP situation with some deficits on that. So is there anything fundamentally that we can talk about from a rupee dollar point of view to discuss that in detail?
So I think there is a short-term view and a long-term view on rupee. I think the short-term view is not only driven by fundamentals, but there is a lot of liquidity and geopolitics around it. And I think that's much harder to pin down. But I think when you look at it from a medium-term to long-term standpoint, essentially currencies should reflect, or depreciation in currencies should reflect differentials in inflation. So the greater the differential in inflation, the greater the medium-term prospects of that currency to depreciate. I think that gap has narrowed. India's inflation seems to have structurally come down, and it is a fair amount of that has to do with our fiscal discipline. And as a result of that, we should see, partly driven by that and of course other factors as well, we should see a lower inflation scenario in India compared to the past. Versus that, globally the situation is quite different because of labor shortages and so on and so forth. There is an argument that can be made that inflation could be a little bit stickier than what it has been historically. As a result, if the gap narrows, then over a period of time, rupee depreciation should be a little bit less than what it has been in the past.
So thanks, Chirag. From an earnings growth point of view, I think in the last 1 year, we have seen the mid caps especially drive a lot of earnings growth. And I think one of your points in terms of your little relatively much more comfort on the valuation is to do with this earnings supporting some of the mid caps, etc. But from an overall market capitalization perspective, you did give your view on the valuations. But from the next 1.5 years perspective, from a earnings growth point of view, what do you see? I mean, we've had post-COVID, we've had 2 strong years. I think last 1-2 years have been little subdued. But is the growth coming back to the normalcy kind of levels in the next year?
I think there are a few things to think about. One is, as you pointed out, the base effect is now a lot more benign. So in the last, I think 6 quarters, we've seen earnings growth of 8 to 10%. And the period prior to that, earnings growth was 15, 20, 25%. So I think the base is a lot lower, and I think hence the opportunity to deliver growth on that is a little bit better. However, I think the headwind is that while real GDP growth continues to be very strong at 7.5%, nominal GDP growth has certainly come off by 2-3%. And that will pose some headwind to earnings growth. So I think there is a benign base effect. There is some headwinds from nominal GDP being under pressure compared to the past. But when you break it down at a stock specific and sector level and so on, I think the outlook for earnings growth is still reasonable, and we can certainly deliver low double-digit or the expectation certainly is that we will deliver low double-digit earnings growth. And I think that's something, I think the earnings expectations have certainly become a lot more reasonable. So if you go back in the last 6-8 quarters, we've seen significant downgrades. So the downgrade to upgrade ratio was significantly in favor of downgrades. So it was almost a 3:10. And now that ratio has changed quite a bit. It's almost evenly balanced, which means that for every earnings upgrade, we are now seeing a downgrade. So it's more or less 1:1 versus 3:10. 3 upgrades for every 10 downgrades. So I think it's becoming a little bit better. I think the expectations have come up. The base is a little bit lower. Little bit of a headwind from nominal GDP, but I think this double-digit earnings growth at this point seems to be, I think the expectation is reasonable.
So it's heartening to hear from you that structurally our inflation has softened. I mean, it's not a temporary phenomena. Probably for the lower inflation or the RBI's inflation targeting is somewhat in the range, and the differential has narrowed. But you also mentioned the other side of it. Nominal GDP growth has come down. Historically, when it comes to setting long-term return expectations from equity investing, we've had the chart on our decadal nominal GDP growth, and I mean, from a long-term perspective, nominal GDP growth has resulted or reflected in earnings growth, and that has to somewhat reflected in the investment returns as well. So is it also the time to kind of bring down the return expectations from a equity long-term point of view? Because historically we've had extremely high teens kind of returns from equities. From a investor expectation setting point of view, is it prudent to kind of bring it down as well?
I think it's always prudent to bring down your expectations. I think that's great to have. It's always low expectations, I think, lead to better outcomes. The opportunity to get surprised is that much more. Having said that, I think that a little bit lower expectation of returns is something which is sensible, because we are still in an environment where the market is at a 10-15% premium to its historical 10-year average. So I'm not talking about the growth part of it, just the valuation bit. So if your starting off point is a little bit elevated, then you need to bring down your expectations of returns. So I think a couple of percent of lower return expectation is something which makes sense, considering that we are starting from a slightly elevated valuation standpoint. And in mid cap, small cap, it's a little bit more, but in aggregate, I think it makes sense to bring down return expectations. I think this nominal GDP growth bit, I think some of this inflation is structurally lower, some of it is also cyclical in nature. We've had good monsoons and so on. So over a period of, I'm not sure over a medium term whether inflation will not pick up a little bit from here. We still have a lot of constraints from a supply standpoint, all of that. So I think earnings growth of 12-15% over an extended time frame is still something which is achievable when we look at it at a sector and stock specific level. But bringing down return expectations simply because the starting off point is a little elevated, I think that bit makes sense.
From an investor interest point of view, I mean, I can see the questions as well. I mean, these days no discussion is complete without.
I can interrupt you and I can guess what the question is, right? No, but go ahead. I'm sure it's about precious metals, but go ahead.
Yeah, exactly. You are bang on. I mean, the question that comes is on the gold and silver. I mean, we've had a situation during the Diwali time, there was a peak. Then things came down a bit, and then now there's like a big rally that we have seen, and it's like from then that level also there's a huge rally that we've seen. And in terms of the interest from investors, in terms of the gold funds and silver funds, there's been heightened level of interest as well. People have started asking question why you don't have gold and silver in flexi cap also, that kind of the question. So it's kind of there's a lot of extreme exuberance or something that is currently prevalent. So obviously people directly ask this question, where do you see gold and silver in the next few months or something? But what do you have to say from an asset allocation perspective? At this point in time, does it make sense to kind of stagger your investments? There's a lot of SIPs that have come in the industry in the last many months also in these asset classes. So what do you have to say from an asset allocation perspective?
So I think there are a few things to think about when you consider the rally in gold and silver. I think whenever these kind of rallies happen where gold is up by 60%, silver is up by 170%, whenever these rallies are massive, they tend not to rely only on one leg, right? Which is, it cannot only be about sentiment and liquidity. There has to be a fundamental underpinning to support that rally. And it is certainly there both in gold and silver, right? Whether you look at it, silver in specific, if you look at production over a 10-year period is down 7.5%, demand is up by 15% over the last 10 years, and we've had new sources of demand in the form of EVs and so on. As a result, there is a fundamental reason to argue that silver prices should move up. Supply is constrained because silver is essentially a offshoot of zinc production, etc. So there is a fundamental underpinning, but there has been obviously a lot of sentiment and liquidity which has also been thrown at it, and that's why both these commodities are up as sharply as they are. Now, the investor interest will always follow where the momentum is, right? If you go back 5-7 years ago, there was huge interest in PSUs because that's where the momentum was. Then a few years ago, there was massive interest in mid cap, small cap because that's where the momentum was. Today, the momentum is in precious metals, and that's where a lot of the interest and questions are coming from. I'm always careful when something does extremely well. It tends to normalize over a period of time. The reality and the perception tend to meet. I would be very careful to get into commodities which have rallied by 150 and 70%. A lot of that is, I don't think those kind of moves are justified purely by fundamentals. There is obviously a lot of sentiment and liquidity which is being thrown into those segments of the market. Hence, I would be very careful. I think people are right now over-indexed to gold and silver compared to what they have been in the past. I think my fundamental nature is to look at things which have not done well. If a market has not done well, or a segment has not done well, or a sector has not done well, for me that piques my interest. I think when segments do as well as they have in gold and silver, I think that's the time to look at profit booking. One can argue whether the profit booking should be entire or 50% or 20%, but certainly taking some money off the table in precious metals, specifically these two, will certainly make sense. Now, having said that, these are also there is momentum here, and they are also seen as safe havens. So if the momentum is not going to stop just because we feel it has become exaggerated, it can continue. The safe haven status, especially in this kind of environment where we are seeing so much of news flow, can also lead to investor flight to these commodities. So essentially in the short term, can these commodities continue to rally? Of course they can, right? Because of these variety of factors. But from a medium term standpoint, and certainly from a longer term standpoint, these asset classes have done ridiculously well, and there is no fundamental underpinning for that. And hence it makes sense to book profit. I think getting cute and trying to time that last bit is tempting, but always a little bit dangerous. So I think this is a good time to get out of these things and shift allocation to segments of the market which have not done as well.
Very interesting. I mean, you made a point. I mean, you're naturally inclined towards something that has not done well. So there's this sector and thematic questions that keep coming and interest investors. So between various themes, sector, there is consumption, there is transport, there is pharma, there is tech, banking. So what interests you at this point in time from a long-term perspective? I'm sure there is no bad sector in India. I mean, from a long-term perspective, every sector should do well. There is, I mean, you can correct me on that, but from a medium-term perspective, which are your, favorite sectors when it comes to portfolio positioning?
To be honest, we don't have favorite sectors, right? Our DNA and our investment philosophy and style and approach is very bottom-up in its orientation. So we create portfolios on a bottom-up basis, and then we manage sector allocation and risk at a top-down level. So there is no sector that we love or hate. There are sectors that we don't like, but companies within that we like, and vice versa. There are sectors that we like, but companies within that we don't like. So I think you have to get very, very granular. Companies have very different business models. Even within a homogeneous sector, you can have a very different approach and a different strategy. So you have to look at each company. I mean, pharma is a great example. You can have a domestic approach, you can have a generics approach, you can have a CDMO approach. It can be various combinations thereof. You can be more innovative in your approach. So I think you cannot, paint pharma with the same color. You can't paint IT for that matter. It's a more homogeneous sector, but the profile of mid caps, small caps can be different from large caps and so on. So in every sector, one can argue. And I think that's the way we think of it, that it is better to look at it at a stock specific level as opposed to at a sector level. Now, having said that, sectors which are relatively ignored or sectors where valuations are more benign, it's easier to find opportunities, right? The hunting ground is more fertile because the valuations are in your favor, and hence it's easier to find opportunities within that. It doesn't mean that we love the sector. There'll still be companies within it that we don't like. But as an example, and I think this has been spoken a lot about in the last year or so, financial services has been a sector where valuations are more sensible than in other sectors. So when the environment or the sector itself is more favorably priced, then finding individual opportunities becomes a little bit easier. Obviously, if the sector is expensive, it becomes correspondingly harder. So I think that's one sector which stands out. But I still believe that as opposed to themes and sectors, the key is to be stock specific and invest the way in which the approach which is suitable to you, but to be stock specific. I think, especially in India, with as many companies as we have, as diverse as they are in their models, I think that makes more sense.
So as we get closer to the budget and other policy measures like the monetary policy, and it's around the corner, maybe another 10 days we'll hear from the policy makers. But we've seen some measures like we discussed on the consumption bit and GST cuts, etc. So throw some light on the government finances as the government goes to the budget. What could be the priority areas? Would it be pushing growth from a domestic point of view? Any thoughts on the budget expectations?
I don't have a very strong view. I don't think that the policy of the government is going to change dramatically one year to the next, right? It is obviously going to be growth oriented. We've seen that time and time again. It is obviously going to also support the rural economy, which we see time and time again. There will be some focus on investment and some shift in priorities here and there. I think the days of budget being central are behind us. You've got 365 days to introduce measures, and this government is active enough that it's using that time period effectively. So I don't think you have to rely on one particular day to bunch up all your announcements in that given day. So I don't think, do we remember the budget 2 years ago or 4 years ago or 5 years ago? We've forgotten about it, right?
True.
So it tends to be very central and very topical, and hence we discuss it and talk about it. But I think there is so much more that happens outside of the budget. But I think it's fair to say that the big observation that this is not something that is a revelation has been discipline, right? Fiscal discipline, and especially in India has been strong, especially when you consider the lack of discipline you've seen in some countries outside of India, where they've chosen to spend a lot more from a fiscal standpoint. I think India has been far more disciplined and maybe has not got its due recognition.
Sure. Chirag, I've heard you talk passionately when it comes to our investment process and the research process, the rigor that the team goes through when it comes to analyzing the bottom-up stock picking part. We also give significant importance to our philosophy, the legacy, the long-term track record, and the clear view on the long term. But throw some light as to when it comes to the process, how much of it is team-based decision making and how much of it is kind of an individual's responsibility?
Well, certainly it's a combination of both, right? And it's unfortunate that these interviews and conversations happen one-on-one, right? Because we are the face of the organization as fund managers and as CIOs, etc. But the heart of the organization, which is far more important, is our research team. And we have a research team of 13 individuals. They're incredibly talented. They have a lot of experience. So our average experience is close to 15 odd years. I don't think we unfortunately get to showcase them enough, but I think that is the bedrock of what we do. Where do my ideas come from, right? Of course, some of those ideas come to me individually, but most of those ideas are generated by the team. And that is our clear strength. In addition to our philosophy and culture and so on. But I think the kind of people that we have, the talent that we have in our research team and in our fund management team, I think is our clear strength. From a philosophy standpoint, we are a part of HDFC. We are very long term in our thought process. We are conservative in our thinking. We like to stick to the knitting and invest in businesses that we understand. We are value conscious or value oriented at least, and very, very bottom up and very research driven in our thought process. So I think that certainly has helped us over a period of time.
Chirag, thank you very much. Thanks for joining. It's been a really insightful discussion we've had today. And thanks to all the audience that have joined today. Thank you very much for joining. Thanks.
Thank you, Ram.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.